Vitrio Financial is proud to support Improving Alpha, Innovation in Investing, ESG and Technology with Michael Oliver Weinberg. Vitrio helps allocators harness investment complexity to make better allocation decisions. Learn more at vidrio.com. That's vidrio.com.
Hi, this is Michael Oliver Weinberg. We'd like to welcome everyone to the Improving Alpha, Innovation in Investing, ESG, and Technology podcast series. Today, Tobias Read, State Treasurer from Oregon, will join us. So listeners have a high-level sense of our roadmap. We'll start with some background, then discuss investing, ESG, and technology. Investors and business leaders should be able to extract a great deal of value from Tobias's insight. On that note, welcome, Tobias.
Thank you. That's a high bar. I hope to meet it.
No doubt. Having spoken at conferences with you in the past, it'll be easy. Look, and in fact, Tobias and I first met at an ESG conference, which was quite well done. Let's start briefly with your career and how it evolved to where you are today.
Well, thanks. I really have had a varied career, and I'm really proud of the fact that I've had interesting roles in the public and the private sector. After I finished college, I had the opportunity to work in the development office at my alma mater, and that eventually led to the really rare opportunity to work for the U.S. Treasury Secretary. So as a young person, I did briefing books for Larry Summers, learned a little bit about lots of different things, which convinced me that I wanted to better understand the relationship between business and government, the public and private sector. And it took me to business school at the University of Washington. And from there, I had a chance to try to experiment more with my contention and still convincement that companies do better in the long run when they care about the environment in which they operate, the workforce, the broader economy, and so on. And so I had a chance to work at Nike for 8 years as a footwear developer. Oregon has a part-time legislature, so during that same time, I ran for the legislature, which I found to be a lot like college, with committees that are sort of like classes and a need to discover a legislative major. I don't think it's also like the market in that you can improve your chances of doing something useful and succeeding at it by going somewhere where not everyone else is. So I found myself, based on business school experience, and worked at Treasury, working on things that the treasurers and the Treasury work on. And in 2016, ran for treasurer, was reelected in 2020, and have really enjoyed the experience working on things that are, I think, in a lot of ways different than a lot of the rest of politics, in that we have not only the opportunity, but the really explicit responsibility to think about the long run, the impact of choices that we're making now, the obligation to look out for the funding of the pensions that so many public servants have earned in Oregon. And it's been a great experience.
That's a great segue into how big is the plan?
So our pension fund is just around $100 billion in terms of the assets under management. It represents about 400,000 members. And it's a classic, at this point, hybrid plan. There is a tier that is defined benefit, and the more recent entrants have a hybrid plan that has both a defined benefit and a defined contribution portion.
But the defined benefit is still open. It's not frozen or closed.
It is closed. The exclusive defined benefit is closed, has been closed since 2003. The new entrants since then are part of what we call OPSRP, the Public Service Retirement Plan, that is the hybrid. Got it.
Okay. Thanks for that clarification.
You bet.
It's super interesting, by the way, that you worked for Larry. I think he's a super thoughtful person and economist, and I think he nailed some things during the pandemic. I remember listening to him at the Economic Club of New York, and he was spot on.
Agreed. Yeah, he was an excellent. Had to be around and learn lots of different things. So I credit a lot of thinking and experiences I had to that experience, and the experience I had just before that of working as an intern at the U.S. Treasury when Secretary Rubin was in office.
Oh, yeah. You're another. I've had the pleasure or fortune of spending some time with Rob Rubin as well, and another great mind. Both super impressive people. And then in terms of the fund, what's the funding status like? Where does that stand?
We're around 80% or so. And of course, that's always most questions that I get asked, I can usually answer starting with compared to what. And that's the case here because most people, of course, in their real world and certainly in the legislature, even people who are deeply involved in politics don't spend the time, nor should they, that we do on this question. And it's easy, I think, for pensions to get caught up in politics and for people to get really fixated on the unfunded actuarial liability or to use that as a political football. And we've seen that in Oregon over time, but I often try to explain to people what it really means. It does have an impact in terms of budget because it's dollars that aren't available to invest in education or other things that we might want, but it is not the sort of thing that is a fiscal crisis in the sense that we're in danger of immediate collapse or something. And sometimes I find it effective to ask whether a person who is concerned about this has a mortgage, and then ask them if they could pay off their mortgage in cash today. And most people will say no. And I explained that they too have an unfunded actuarial liability, but it is possible for them to eat food and wear clothes and live in the house. That it's something they have to consider as they make financial decisions, and the same is true for us. So we've been really relentlessly focused on taking the political grandstanding that is possible out of that conversation and try to be a source of trusted information for legislators and decision makers and talk about the impact of choices we're making. We have a world-class team of investment professionals, and we've been fortunate to continue to make progress on knocking that liability down. Of course, we've benefited from what the markets have done, but we've also made really smart decisions in our execution, our implementation, and the style with which we do those things that I think are contributing as well. And I think we've been fortunate and happy to see increasing confidence in the way our pension is managed.
That's a great transition to the next topic, which is, and how are you innovating to improve alpha from an investment perspective?
Well, Oregon has a really long history in this. I would say, in general, if the spectrum goes from Canada being all internal to Yale being all external, we're somewhere in between. One of the things I just was sort of alluding to was support we gained from the legislature when I became treasurer at insourcing some significant portions of our pension by adding capacity. We got approval to add quite a number of brains to our team, so we can do that work less expensively in Oregon than we might hire people from where I think you're coming from. And Oregon is also the first state pension fund in the country to have invested in private equity. So I think the alpha that we're really seeking is in the selection of those managers, the smart deployment of our resources. And in particular, owing to the conference where we met, we're excited about the ways that we can both reduce the risk that climate in particular is introducing into the pension, and where we can find new opportunities for success, new climate solutions. Those are all big parts of our strategy going forward.
Perfect. That was the next topic. And again, in innovation to improve alpha from an ESG perspective. So maybe you could delve into that a bit.
Yeah, I think the key is how much we talk about in popular culture and political culture right now. I think so much of our discussion in terms of climate is the horrible things that we want to avoid. And I'm not suggesting that we not talk about that, but I think it is of some value to supplement that conversation with all the ways that the economy can grow, that life can be better and much more pleasant if we embrace the opportunities that climate adaptation and solutions can represent. And I think the idea that pensions, being long-term investors, such contrast to a lot of other investors, have a real role to play in that transition. We can afford to make longer bets, and I think we should. In fact, it's my strong contention that a person, an investor, is not doing their job as a fiduciary if they are not taking into account both those risks to be avoided and those opportunities to be sought. So that is something that matters to us across our portfolio in every asset class. And I think anyone who doesn't admit how much more work we all have to do in quantifying those risks and those opportunities and integrating them into every part of the investment process, from manager selection to diligence to risk management, all of these things, they're not being honest because we got more work to do there. That's part of our responsibility, and it's part of the nice overlap between what it takes to be successful as an investor and what the rest of the world is going to need desperately.
And I spent a few years at APG, obviously large Dutch pension. And while I was there, we transitioned from effectively from engagement to exclusion of fossil fuels, for example. And I wrote an article last year that II, an institutional investor, published that, where I espoused a case for engagement rather than exclusion because, for many reasons. But curious to hear what your thoughts are on engagement versus exclusion.
Well, let me start by contrasting what you said to what a lot of other people say. And I have a really hard time when people start, which you didn't, with divestment, because it means so many different things to so many different people. And so I really bristle at that and I appreciate the fact that you used exclusion. It's better, although it has some of the same definitional challenges, because as I expect that we are certainly going to exclude some things. But the difference for me between divestment on the one hand and this is maybe a little more crude or provocative than I mean, and divestment on the other is strategy. I don't want to make a blanket statement and say we are divesting from anything, because that seems to suggest that I've made the decision prior to understanding data. I think we will definitely sell things over time, but that isn't, for me, the notion of divestment. That's the notion of concluding that it's a bad investment for any of a number of reasons. So I can imagine us saying we're going to exclude things that have a certain risk reward profile, or we're going to try to, I guess one way to think about that is a fossil fuel company that has a plan for a transition might be looked at very differently than one that is denying the existence of climate change.
Yeah, right.
So
right.
That's one big distinction, because after all, that might be the fossil fuel company that is in best position to discover a viable alternative, or a successor platform, and we certainly want that to succeed, and we'd like to participate in the financial gain from that. So I do think engagement has a lot of advantages, and no one listening to this will be surprised when I remind myself as much as others that in order to sell something, you have to have someone who's buying it, and by definition, they're probably less concerned than the person selling it. So we'd give up our seat, we'd give up our influence by selling things. I do think there is an ongoing question that we're all struggling with, the fundamental sort of or what question. If engagement doesn't work, then what? We have to keep at it. We have to continue to exert our influence as investors to try to move our individual investments to a place that they're going to succeed over time. And I don't think there's any way to do that without accounting for the very real risks that climate presents.
Well, I mean, look, this might be a sort of extreme answer to your question. If engagement doesn't work, then what? I might say, if engagement doesn't work and you think they're destroying shareholder value and/or, destroying shareholder value, I might argue you should short the stock.
That's a possibility, as are asserting our rights as shareholders in the legal context too. There's interesting things happening in court cases around the world, but you're right. That's another good form, and that might well play a role. You're right.
Yeah. Okay. Shifting gears from that, I don't know if this will be as relevant, but what about from a technology perspective? Anything any innovation to improve alpha from a technology perspective?
Well, we have as a big portfolio, we have to continue looking for all the ways that we can automate our understanding of our exposures and the various risks, and we're always looking for those opportunities. And I do think that's in the sort of internal implementation side of things, but I think there's also good use in or utility in thinking about where that technology will apply to physical realities of climate as well. We're really interested in those opportunities that can address real issues. We think about that in terms of wildfires a lot in Oregon. There's a good example of a collaborative approach amongst the universities in the Northwest around automating surveillance technology to spot wildfires at an earlier stage so they can be suppressed more quickly and make those forests more resilient and our populations less vulnerable. So they can apply in a lot of different contexts, I think.
Yeah, that sounds very sensible. I mean, especially in light of what we're seeing, where, as I'm sure you're intimately aware, insurers are pulling out of states like Florida and California because the risk return is it's uneconomical at this point.
Right.
So if you could, to your point, suppress that damage earlier or detect earlier and diminish or limit, that sounds great. What you mentioned, you were really a pioneer, if not innovator, of private equity investing from a public plan perspective, which is great. Where do you see either the best or an interesting opportunity from an investment perspective now?
I think we have a couple sayings that come to mind for me right now. This is not unique probably to Oregon, but we remind ourselves all the time that every basis point counts. When we're talking about a pension fund that is as big as ours, it's easy to get lost in those numbers, but it represents real existence for individual retirees, and every bit that we can make a difference there matters to them and matters to the state. In that, as we talked about earlier, it's an opportunity for the state to make other investments as well. A dollar from investment returns is a dollar that doesn't have to come from elsewhere in the budget, so it matters. We've had, I think, a lot of success and interesting progress recently by adding a new, for us, approach to co-investments that we've talked about fairly publicly in the private equity space. That is a really direct attempt to save fees and allow us to better fine-tune our pacing. We're not so arrogant as to think that we're any better at picking individual deals than we are at picking managers. So we use that to take a proportional share of all co-investments and fine-tune that pacing. That's been successful for us. And I think the other thing that matters here is the famous Warren Buffett quote about what happens when the tide goes out and we see who's been swimming naked. There's a little bit of that as we, I think, reset into a different environment around interest rates that causes us to think it's time for us to go back to basics and really double down on understanding the managers with whom we have relationships and their fundamental attitude about how they invest and how that all fits together in this large and sophisticated portfolio. Overarching all of that, I've made reference to it several times, but I think it bears repeating more specifically. I made a pledge last fall to spend this calendar year of 2023 in building, or at least assessing and building a plan to get the pension fund to net zero position on carbon emissions by 2050. That is a big challenge, and especially as we try to do it in the context of our fiduciary responsibility. That, I think, is a huge opportunity, and it's an opportunity, as I've said repeatedly now, both to avoid risk and to realize additional return.
What are the biggest levers that you can pull to achieve that, if that makes sense?
It does, and I think it's the stuff we've been talking about. It's being intentional about understanding the attitudes of the people with whom we entrust to manage retirees' money. It's being intentional about seeking out those opportunities that are built for a changing climate. It's looking at the places where we can plan for the delay in achieving climate stability. What's happening around the world, and it was interesting to watch the East Coast have the realization about the impact of smoke that we did several years ago. You can't avoid it. That's going to cause people to have different reactions and make different choices, and our portfolio needs to be prepared for that, just as we are for all kinds of other scenarios. Over time, I think Oregon has taken the attitude that we are comfortable not being the highest of the high in bull markets, in exchange for being not the lowest of low in bear markets. And that has proven to be successful over time. And look at our ranking relative to our peers. That's really good over time. I frequently will get people comparing us to the S&P 500. Well, the S&P 500 did X. Why aren't you doing that? And it's pretty easy to say, because we're not trying to be the S&P 500. Our obligation is over the long run. And so the levers are, I think, continuing to consider all those choices. How's the portfolio constructed? Where can we assert our rights with our shares, voting on our shares, as we talked about before, shorting or engaging in legal actions? All of these things, I think, are part of our toolbox and our obligation on behalf of our beneficiaries.
Yeah, look, I couldn't agree more with you. I think conceptually you and I have the same philosophy in terms of why constrain your toolbox? Why not,
Yes.
keep the greatest optionality so that you can be thoughtful and create the greatest value in given any set of circumstances?
That's right. And I think the fundamental difference where you and I are aligned and where people often forget is that if someone says to me, your job is to maximize returns, I have a very hard time not coming back with the sort of snarky quip, to whom over what time period, because depending on the answers to those questions, you could come to very different conclusions. We got to think about the 70-something-year-old teacher who retired last year in the same way, or to the same degree that we think about the 20-something-year-old firefighter who just started her career and has a really long investment horizon. That's an obligation that we have in both cases. So we've got to balance all that long horizon, which is different than someone who's just investing for next quarter.
When I was at APG, the Dutch pension, this is something that we discussed quite often internally, the investment staff, and in both the Dutch and U.S. investment staff, in terms of if you're making decisions based on ESG and not economics, you have a fiduciary duty to the beneficiaries, right? And you have to put their interests above your own, obviously, and ahead of your own. And, would they sacrifice return for ESG, and or how much return would they really sacrifice for ESG? How do you think about that? Because that's something where we often felt there was, individually, again, just personal opinion, felt there was too much return being sacrificed for ESG.
Well, I think this is the heart of it. I had a conversation with someone not too long ago where this person said, I think the pension fund just needs to be invested in accordance with Oregon values. And it's an interesting thought for a moment. And I did think about it for a minute. And then I just asked, as politely as I could you tell me what Oregon values are, please? Because I don't think any small group of people, unless they're selected specifically for this purpose, could agree on that, no matter how small, because everybody's got their own values. And then add to the fact that we have 400,000 retirees that we're investing on, and any definition of that, I think, runs into problems because there isn't really any universal definition of it. But what I also tell people is that the good news is, by emphasizing financial return, I think in the long run, it aligns pretty well with a lot of the other things that we might share as values when we don't have our fiduciary hats on. A growing economy, which contributes to that financial return, needs a healthy physical environment. It needs a respect for, and the rule of law has to control. It's going to need infrastructure to move people and things around. So a lot of this stuff is consistent. There's great legal and academic discussion to be had around the impact of community on quality of life and sort of total returns. But in the short run, we can get a lot of the way there by focusing on long run economic returns. And I think we got more than enough work to do on that front for the foreseeable future.
Yeah, I couldn't agree more. And to your point, I've said this I've been teaching ESG as part of our course that I teach at Columbia for the last decade at the business school. I mean, to me, ESG is so subjective, to your point. I mean, one man's exclusion list or one woman's exclusion list is another, could be the entire opposite for another person or man or woman.
I am sometimes kind of aghast when people say to me, "Oh, this is the responsible investing portion of our portfolio," and I have to resist saying, "What does that mean about the rest of your portfolio?"
Yeah, right. It's irresponsible.
Yeah, exactly. So, respectfully, Michael, I think we will succeed when your class is irrelevant and moot. When it is assumed, when you have to have the reverse of that situation, when you have to say, well, this is our irresponsible portion or our allocation, because everything else is. What are we doing if we're not saying every risk, every material factor is part of our process? Whether you like it or not, it's a factor, and we're not doing our job as a fiduciary if we're not considering it. I would not be so presumptuous as to say, consider it and come to this conclusion. But I think I can say on solid ground, if you are not considering something that is material, then you're not doing your job. And that is frustrating to me to watch people say things like that out in the world.
Yeah, fortunately, ESG is only a part of our class, but I will tell you, I think, again, I mean, you and I are fairly aligned in terms of, look, ceteris paribus, if you can make the world a better place and achieve the same economic return, that's optimal. Yeah. But if it has an economic cost that's material, then that has to be considered, and it's not necessarily. I think you and I both come from a profit first, not an impact first investment philosophy.
In the context of a pension fund, we have to. That's right. How you invest your money, how I invest mine, might be a totally different thing. But I tell people all the time, legislators in particular, if I can tell you one thing about the pension fund, it's such a simple thing. Remember, this is not public money. It's amazing how many people do not have that understanding, and they'll say things like public money should do this or shouldn't do that. I say, that's not what the pension fund is. It doesn't belong to me, it doesn't belong to you. It belongs to the people who have earned it, and we have to invest on their behalf.
Right. Completely agree. Very, very, certainly an important nuance point. I will say one thing, though, in terms of the APG I've been discussing, in fairness, see, they're fairly unique in that they had 4 components to their fiduciary duty: return, risk, cost. Okay, fairly basic. But responsible investing, or ESG, actually was a 4th dimension. So that gave them a lot more latitude and the ability to make these trade-offs, whereas others, to your point, like yourself, ESG, I assume, is not embedded in your fiduciary duty.
It's not in our fiduciary duty. It is in our investment beliefs. But the definition, as you well know, of fiduciary duty is different in the United States than it is in a lot of Europe. And that also is an interesting debate to have. But presently, we're operating under a fairly strict definition. And as I said, I think we get a lot of the way there under that definition. And hopefully, some people much younger than the two of us will have the capacity to have that debate and make those adjustments in the decades to come.
Right. Have you changed your portfolio because of inflation or either your inflation outlook or?
Not in a material way, because this gets back to, this is with apologies to Ray Dalio, the attempt to build an all-weather portfolio here. We've had assets and styles and strategies that for a very long time were not paying off, but were there in the event that inflation did spike, and they performed well. So it has not changed in a material way, and we continue to assess as we always do, but not so far.
Yeah, look, I think that's very sensible. Again, I mean, I've watched some other allocators, within the last year, build inflation components to their portfolio, and basically, what, if anything, right, over the last year, what we've seen is inflation having largely peaked and at the least decelerating, and we've had disinflation, not deflation, but disinflation, and so I think that's probably more sensible, frankly, if it causes them to pay attention to that and to develop a sensible strategy. That might be a good thing, but so far we haven't seen reason to deviate from our plan. Yeah. Anyway, I don't disagree. Look, what's the material mistake you've made when investing, but more importantly, what was the lesson learned?
Well, of course, we're infallible at the Oregon Treasury. We don't make any mistakes. Well, there are obviously lots of mistakes over time, but I think what it really points to as a lesson is how important it is to have lots of different views in our process. I think mistakes are inevitable, and with the benefit of it's important to distinguish between bad result and bad process, and we really want to focus on the elements that are not chance, that are around process, and give great credit to one of the institutional sort of hallmarks of Oregon has been this process and the addition many years ago of an investment council. Unlike, there are still a few state treasurers who are sole fiduciaries, and that while I have respect for those individual people, there's some danger in that, and we don't have that in Oregon. We have a council which I refer to as kind of our legislative body. I'm a voting member by virtue of being treasurer, and there are 4 other people who are appointed by the governor and confirmed by the Senate. That's where we go to set allocation strategy, where we talk about risk, where we talk about those big strategic questions that I think provide the level of external oversight and diversity of opinion that really protects us from making predictable, avoidable mistakes. That's something that all of us, I think, in Oregon really value and are committed to continuing.
Yeah, well, it's a book I quote often is James Surowiecki, Wisdom of the Crowds. If you have if you have many informed views, the decision is often better than less and uninformed views. So it's been
a long time since I read that book, but I remember liking it.
Yeah. Same here. Okay, and speaking of books, what is there a favorite book you have or one you've read recently that you liked?
Yeah.
Could be investing or not. Sorry.
Yeah, I was just going to say, I think I'd put 2 categories, and it's one of my favorite questions actually to ask people what the best thing they've read or watched recently. There's just too much in the world for any one person to take it all in, and I find a lot of value in encountering things I wouldn't otherwise know about. So there's recognizing that there is some pretty serious recency bias here, and the fact that I work for him makes a big difference. But I really like Ruben's recent book, The Yellow Pad. Speaks to a lot of the stuff that we've been talking about here around uncertainty, around decision making, and it's well written. It's enjoyable. It's a lot of memories and experiences that he's relating in a memoir sort of format. And it was kind of striking for me as I read through it to realize how much of his thinking, even in the short time I was around while he was secretary, have stuck with me in the way I seem to approach things. So I really like that one, and I never miss a chance, particularly with a wider, more widely dispersed audience and someone on the East Coast, to talk about my favorite book ever, which is not related to investing at all. A River Runs Through It. Very short book, 120 pages, something like that. I was born in Missoula, Montana, so I certainly have some bias in that respect. But what a beautifully written short story that speaks to much more timeless and universal themes about family and relationships and what matters. So those would be my 2 for today.
Excellent. Good stuff. What advice do you have for allocators and investors, if any?
I think the biggest one we kind of covered already in your question about inflation, which is having discipline and thinking about the long run, not getting distracted by noise. It's maybe just a restatement of the advice we all give ourselves in the midst of turmoil, which is, don't look at the horizon. Don't look at the what your daily balances are. And I think that speaks to another aspect of the answer, which is how important it is to know your strengths and to be cognizant about whether they are still an advantage in the marketplace. Is the market changing? Is what you thought a strength still a strength? Being self-reflective on all those things, but not reactive, I think can be a real source of advantage.
As is the case with much of what you've said. Very sensible. Look, and to wrap it up, what didn't we discuss that I should have asked you, or you're discussing with other investors, or is anything else that's topical that you think you'd worth sharing? Or
I think I definitely hit on the point that I try to make with everybody, that these dollars are not ours. They're not public money. I think it's worth something that I always remind myself as I started to talk about, but I don't think I finished. Easy to get distracted by these large numbers. I don't know people who talk in their own lives about billions at a time, but we do that all the time in the pension. But that is not the experience that individuals have. The median benefit in the Oregon retirement system is about $30,000 a year. So that really matters for me, to ground myself, to think that as we're making these decisions, that has the potential of impacting whether someone can buy groceries or pay their utility bill. The contrast between those two things is really important to keep in mind. And then I think the net zero pledge that we're working on now, we're not the only one who's struggling with this, but I think we are taking it as seriously as anyone else. And I'm really looking forward to how we can build that plan, what the conversation is going to be like with our investment council and with other institutional investors, because we have a role to play for sure. That's why we're doing this, but we're not going to be able to do it alone. I have a lot more optimism based on the passage of the Inflation Reduction Act and the various other bills, but it's going to take investors, institutional, individual, pensions and others, to try to supplement that public capital through the Inflation Reduction Act, and to try to deliver the outcomes that we need from a climate change perspective, while we're delivering the financial returns that we owe to our beneficiaries.
Yeah, well, I'll tell you, I was I had the privilege of having dinner with Mark Carney at about a year ago at Milken, and the amount of infrastructure investment globally, the numbers are extraordinary in terms of for the energy transition and what you're alluding to, and right, that will be a confluence of public and private, and right. The opportunities will be massive from an investment perspective.
Right. Yeah. Lots to look forward to, lots of opportunity, and maybe we'll get to have a conversation like this a few years from now and be celebrating all the great things that are on the way.
Hopefully. Well, look, Tobias, we'd like to thank you for the super interesting discussion and sharing your most valuable asset with us, your time. We hope listeners have a better appreciation how one of our more thoughtful pension leaders is thinking about innovation in investing, ESG, and technology, and how others may benefit from it. This is your host, Michael Oliver Weinberg, hoping you join us again for our next episode, where we speak with another thought leader who will provide insight into this. Thanks.
Thank you for listening to Improving Alpha, Innovation in Investing, ESG and Technology, sponsored by Vidrio Financial. With Vidrio Financial, asset managers, endowments and foundations, pensions, family offices, insurance plans and sovereign wealth funds can cut through the complexity of asset allocation to reduce costs, mitigate portfolio risk, optimize compliance controls, and improve performance analytics. Interested to learn more? Contact us today at vidrio.com. That's VIDRIO.com. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Vidrio Financial and or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.